A very good evening to all of you. Welcome to the class today. This is the revision session for intermediate level, and we'll be doing chapter of capital gain here, and along with that other sources of income. So 2 of your heads would be covered today. I hope people are joining in. Wishing you all a very good evening, and let's try make this class as fruitful as we can. Needless to say, all your questions will be entertained. Please drop your questions and please participate in the session. If you have any queries, you can just give a small message on it. So shall we begin with our first heads of income, or shall we just wait for another minute to make more people join? Meanwhile, I'll just say that students, please, at intermediate level, heads of income plays a very important role here. It's your base to make your understanding build. Now, from now onwards, you will understand how these are applies once you clear it in your articleship, and then you will have a more modified, or I'll say more technical version at the final level. But everything in here is the base to do so. So welcoming you all once again to this live session. We shall start with the first head of income, which we'll be taking up today, is income from the head of capital gain. Now, this is one of the most important most important head, which if we talk about, which is called income from the head capital gain. Now, students, I have seen people at intermediate level think that it is very technical or very tough, but it is actually very easy to understand. First of all, income from the head capital gain. One of the fourth head which we talk about here is this. Now, the thing here is we have to understand is that we are talking about capital gain income. Now, what is capital gain? When it is attracted, what type of transaction makes it attract is all we'll be understanding today. So capital gain income there is charging section, which is section 45. Each head has its own charging section. For PGBP you have charging section 28. For house property you have a charging section 22. What is a charging section? The charging sections enable us to tax that income in that particular head. It's just an overview which gives us the right to tax that income in that particular head. So charging section for making any income, to charge it as a capital gain income, what you have to see is that there is a capital asset, number one. Then there is transfer of that capital asset. Transfer, when I say transfer, it's just not a small sale exchange we are talking about. Transfer includes a lot of things. We'll come to the definition of it. And third, that gain from the sale or from the transfer of that particular capital asset will be taxed in the year of transfer. The year of transfer, basically the year in which the transfer took place. So section 45 tells me that any income will come in capital gain when a capital asset is being transferred, and that income will come in that particular year when the asset is transferred. This is a general provision of the section 45. Now, before we understand how we compute it, it is very important to understand that what is actually covered in this thing called capital asset. What is a capital asset? Now, we go back to section 2. Section 2 gives the definition. What is a capital asset? Now, capital asset is anything which you are seeing around, be it business, profession, anything. If I say first as a pool, anything which you are seeing from a pen, your TV, everything is a capital asset, number one. But then there is certain list of exclusions which make those assets as not capital asset. Think there's a pool of assets, all those things which you're seeing are capital assets, but then there are certain exclusions which make my capital assets, which make that particular asset not a capital asset. So capital asset means any property, any kind held by the assessee, whether or not connected with his business or profession, whether or not connected with his business or profession. So that does not mean only my business assets are my capital assets or my professional assets are only capital assets. No, everything is a capital asset. And another point is, for a foreign institutional investors, if an assessee is a foreign institutional investor, for them, all the securities are capital assets. This you will understand more technically when you go to a final level. But if an assessee is a foreign institutional investor, all his securities are capital asset, and I'll tell you why. The first thing I told you, everything is a capital asset, but then there are certain exclusions. What are the exclusions? Number one exclusion is that your stock in trade. That your stock in trade is not your capital asset. Whether that stock in trade is in the raw material stage or in the work in progress stage or it's a finished good, it will never be your capital asset. So you have to see very carefully stock in trade for any purpose. One thing for the stock in trade can be for me, but it can be a capital asset for you. Suppose I'm a real estate person or I'm into the construction of the buildings. For me, buildings are my stock in trade. But for you, if who are into a textile business, building for you would be a capital asset. Number two is any movable personal effects. Movable personal assets are not capital assets. Movable personal assets are not capital assets. So now when I told you, see the pool. So from that I have excluded all the movable personal assets. But there are total 6 types of assets which are movable personal asset. That means they are my personal assets. They are movable, but they are still my capital assets. They are still my capital asset. The one which are highlighted: jewelry, archaeological collections, drawings, painting, sculptures, or any work of art, my capital asset. So first I told you capital asset, then I excluded personal effects wala thing, personal movable asset I excluded. But in personal movable assets, I told that these, the one which are highlighted on the screen, will become my capital asset. So exclusion is the inclusion of my capital asset. Next is my rural agricultural land is not a capital asset. A rural agricultural land in India. So if there is any rural agricultural land in India, it will not be a capital asset. That means any sale, any transfer of that capital asset will not result in a capital gain income taxable under this head. But the point comes, what is a rural agricultural land? If you see the definition of rural agricultural land, they say an agricultural land which is not an urban land is a rural agriculture. Okay, we know this. But then question comes that what is an urban agricultural land? If I say an urban agricultural land is a land which is not a rural land? No, it will not make sense. So urban agricultural land has been defined as an agricultural land in an urban area. An agricultural land in an urban area. So now question comes, what is an urban area? At your part, an MCQ can come that what is an urban area, how to define it. It's very simple. A municipal cantonment, we all know every place has its cantonment, correct? So if a municipal cantonment has a population of 10,000 plus, that municipal cantonment is an urban area. That municipal cantonment is an urban area. Now, the area which is 2 kilometers from that municipal cantonment, the area which is 2 kilometers from that municipal cantonment will also become an urban area if the population of the municipal cantonment is more than 10,000 but up to 1 lakh. Is more than 10,000 but up to 1 lakh. So you have to see the population of this municipal cantonment. Then this area which is within 2 kilometers of the municipal cantonment would become urban agricultural land if the municipal cantonment population is more than 10,000 but up to 1 lakh. 6 kilometer area from the municipal cantonment will also be an urban area only if the population of municipal cantonment is 1 lakh above but up to 10 lakh. But if the population of municipal cantonment is above 10 lakh, then 8 kilometers ke under area with that municipal cantonment will also be an urban area. The moment they are in urban area, it will become my urban, any land, agricultural land in that area will become my urban agriculture land, and hence it would not be a rural agricultural land. And rural agricultural land is not a capital asset as per my definition of capital assets. And next is very simple. You can easily remember gold deposit bond as per gold deposit scheme section in the year 1999, 1980. You don't have to remember the years, but you can give it a look, or special bearer bonds. So if I quickly wrap up my capital asset, everything is a capital asset, whether business or profession, everything is a capital asset. But stock in trade is not a capital asset. Movable personal assets are not capital asset. But in movable personal assets, there are archaeological collections, drawing, painting, sculptures, any other work of art, paintings and yeah, they will become my capital asset because they are the exclusion from my movable personal assets. Then rural agricultural land in India. So meaning thereby, if there is any rural agricultural land of any other country, it is a capital asset. And your gold deposit bonds. Clear? So there is a question, ma'am, if an artist sells a painting, whether it will be a PGBP or a capital gain. Again, the example goes back to the sense that first you have to see whether it's my stock in trade or not. For a professional person, it is stock in trade. Selling that would result in a business income, not for a PGBP income. So the essence when you understand that something is to be taxed as capital gain, is the first more important step is to see whether the asset which is in question is a capital asset or not. A simple thing for differentiating between PGBP and capital gain is just one thing, is the intent and the regularity. With what intent a person has purchased or has invested in that asset. If I as a person has invested in a particular asset with the mind of earning an income from investment, my intent is to hold on and earn the returns from it, it is my capital gain, capital asset. But if I've invested into an asset with the intent to earn a regular income on regularity basis, then it becomes my PGBP income. So you have to see, again, it is not one particular thing that something is a capital asset for me, be a capital asset for you. You have to see it case by case. It is 2, 6 and 8 kilometer areas, not 2, 4, 6, 2, 6, 8. Municipal cantonment population 10,000, then 10,000 to 1 lakh, 1 lakh to 10 lakh and above 10 lakh. Okay, I'll try on. So now, I told you section 45 subsection 1 talks about the charging section where we have to see the capital asset we saw. The next thing is to see the transfer. What is a transfer? It is not necessary that there is a capital asset and any discardness from yourself will result in a capital gain. You have to see there is a capital asset and then you have to see whether it's a transfer or not. Whether it's a transfer or not. Section 2 clause 47 talks about the definition of transfer. The definition of transfer. Now transfer for ma'am, do we have to remember the definition? Not per se, but the moment you will understand the concept, you will automatically remember it. Again, the transfer covers sale. I sell you, you give me consideration, cash consideration, this is sale. Exchange, that means I give one asset, you give another asset, both are capital assets, transfer, it would be a capital gain. Clear? Then relinquishment. Relinquishment is actually a term used for when you give up a right. When you give up a right. Here you can remember the example of right shares. So when you give up a right, generally giving up of right is called relinquishment of the asset. Extinguishment of rights are like, again, cancellation of rights. Then any compulsory acquisition. You did not want to transfer, you were not putting anything for sale, but it is compulsory acquired. It is compulsory acquired by the government. It is a transfer. Then converting your stock, converting your capital asset into stock in trade. Into stock in trade is my transfer. Even if the assessee is the same, I am the same person. I had a gold jewelry at my house. Now I brought that jewelry into my jewelry business. So now there is a transfer. How I have converted my capital asset jewelry is my capital asset, even though personal effect, but it's an exception, correct? But I transferred it to my business, so the transfer will attract capital gain. Maturity of redemption of zero coupon bonds. So zero coupon bonds are the one which are issued at discount but redeemed at par. So their maturity is also a transfer. That means whatever the difference, the income is the redemption amount of difference and your issue amount of difference would be taxed as capital gain. Part performance of the contract. Sometimes possession of an immovable property is given in consideration of part performance of the contract. Now this is an example. See, by transfer we means completion of transfer. Suppose, just take an example. I and you are the two parties. Okay, you and I are the two parties. As a part performance, I gave you the possession, I gave you everything. Now due to this lockdown, we cannot go to the registry office and get the registry done. Okay, so does that mean the transfer has not happened? No, the transfer has happened because as per the contract, I've given you the possession. By conduct, everything is done. The performance has been completed. Just a mere formality of registry, that is formal by the government rule transferring the title to you is pending, but that does not mean the transfer has not happened. Clear? Lastly, there are certain types of transactions which have the effect of transferring or enabling the enjoyment of an immovable property. Iska simple example, if you can relate, when you are a member, generally this happens in West and South a lot. If you're a member of a cooperative society, what happens is you invest as a member of a cooperative society, they give you the share certificate, and because of you being the member, you get the flat of that particular cooperative society to live in as a possession. Okay, so the moment you give up your membership, because of membership you were enjoying the member property, the moment you transfer the membership or you give up the membership, it will result in the transfer of the capital asset. Here, so if I just say quickly, what are the 7 things? Very easy. Sale, exchange, relinquishment of the asset, extinguishment of any rights, compulsory acquisition, conversion of stock capital asset into stock in trade, maturity and redemption of zero coupon bonds, part performance contract where possession is given, and giving up the rights. Giving up the rights which due to which you were enjoying the immovable property. So gift given, is it a transfer? No, this is not a transfer. This is specifically excluded in section 47, which says transactions which are not transfer. Students, you have to, when you are given an inclusive definition, you have to understand that if that particular transaction is not there, that means I do not have to assume that it is a transfer. Okay, so the moment it is not covered there, that means it is not a transfer. That means it is not a transfer. Gold utensils, capital gain, but silver utensils not capital assets but are personal assets. Fine. Okay, students, it is a understanding. Silver utensils are something which are very common. You and I, everyone has one small bowl of it in houses, right? So silver utensils, they do not treat it as the personal. They do not treat it as a capital asset. That means they treat it as a personal effect item. But gold utensils, having gold utensils in it, is a very, very rare thing, and generally people cannot eat in gold utensils. It is not healthy otherwise also. So gold utensils are something which are very prized possession. The moment it becomes a prized possession, that's why gold utensils are my capital assets, but silver utensils are not my capital assets. Clear? So two things we are clear is now what is my capital asset and what is a transfer. The year in which the transfer takes place, you have to calculate and give your capital gain income. Now, how do we calculate my capital gain income? But before that, it is important to segregate a capital asset into short term and long term. To segregate your capital asset into short term and long term. Why we do so? So that why the income tax authorities have done so that people can invest for a particular asset longer, and when you make investments in a longer time period, you get more attractive tax benefits. Okay. There are two types of capital assets: short-term capital assets and long-term capital assets. And the differentiation happens on the period of holding. The differentiation happens on the period of holding and how much time you held that particular assets. For any securities which are listed, I am talking about securities. Securities include shares, debentures, everything, which are listed on a recognized stock exchange in India, except units, plus along with that, my units of UTI, equity oriented mutual fund, and my zero coupon bonds, if held for a period of 12 months or less, are short-term capital assets. More than 12 months are my long-term capital assets. There are three different classification of period of holding. One is for a particular asset holding for 12 months, another is for 24 months, and third is for 36 months. So if you hold them for more than these period, it would be a long term. If you held it for less than these period, it will be a short term. So in that 12-month category, there is securities listed other than units, but units of mutual fund, units of UTI and equity oriented mutual funds, and my zero coupon bonds. 24 months mean there are two simple things: unlisted shares plus immovable property. Unlisted shares plus immovable property. And in the 3-year period, all other assets will come. Ma'am, example like unlisted debentures, because listed debentures go in 12-month category. Unlisted shares are only in 24 months category. That means my unlisted debentures will go in 3 years category or 36 months category. Or you can say units of business trust. Units of business trust, because units, only two types of units are covered, which are units of equity oriented mutual fund and UTI. All other units, whether listed or not, will come in my 36 months category. Clear? Now we come to understanding of, I'll definitely explain, Arman, I'll definitely explain that conversion thing, but just a basic understanding coming. So now we know what is a long-term capital asset, what is a short-term capital asset. Capital asset, we know transfer. Now the point is how to compute the income. Unlike PGBP, we do not have all those list of additions and deductions. The computation is very simple. You take full value of consideration. Simple life में if you have to calculate profit, how do you say? Sale price minus cost. इसी को थोड़ा सा we have modified. How? To take full value of consideration, that is nothing but your sale consideration, but you use the term full value of consideration. I'll tell you why. Full value of consideration minus my transfer expenses, which are directly related to the transfer, that will come to my net consideration. From that net consideration, I'll reduce two things: cost of acquisition and my cost of improvement. Cost of acquisition and my cost of improvement. After that, whatever will come will be my capital gain, and after that I'll have some exemptions benefit, some exemption benefits under section 54 B, C, D, B, D, F and all. Okay. Now the question comes, short-term capital assets, say whatever gain would be, there it would be a short-term capital gain. From long-term capital asset, the gain would be a long-term capital gain. Clear? Now, this is how the computation of capital gain happens. But as I told you, for long-term capital asset, there's another benefit is given in second proviso to this section, which says indexation of cost of acquisition and cost of improvement. Because you may be holding a particular asset for 15-20 years, and we know that there is inflation. taking those value directly and reducing it will result in huge gain, which is abnormal, right? So bringing that cost to the present value, is called indexation, and we do it only in case of long-term capital asset. And how do you index? In exam, you will be given the CII, which is cost inflation index. You don't have to remember it, but whatever years will be in question, you will be given. So you have to take your cost, simple unitary method. That cost is of a particular year in which you purchased into the cost of the particular year now in which you are transferring. So simple, take the cost into CII of the year of transfer upon which CII of the year first held by the assessor. Here, this is how you calculate your index cost of acquisition, and so is for index cost of improvement. One thing you have to remember that debentures are one such thing and bonds are one such thing do not get indexed. You know why? Because debentures or bonds are like loan. Loan mein there is no appreciation. So debentures and bonds ko you do not index, and this is written specifically in the fourth proviso to section 48. One more thing you have to remember that for shares, when you pay STT, which is security transaction tax, to make any transactions through demat accounts, you pay STT. That is a nominal amount 0.1%, I believe. These are transfer expenses if you see prima facie, but these are never allowed. So deduction for STT will not be allowed. For the seller, it will not be allowed in this transfer expenses here. And for the purchaser, it will not be added in the cost of acquisition. So it will never be allowed. Always remember that. Any questions up till computation? I'll come to your question, Jyoti. We'll do slum sale. You will get the answer. Now, some very important thing comes to the point is, what is my cost of acquisition and what is my cost of improvement? First of all, the basic thing, cost of acquisition is the price which is paid. Simple, correct? Cost of improvement is when you make an additional value to that particular asset. And generally, cost of improvement comes when there is immovable property. Like if you purchased a building with one floor, it will come in cost of acquisition. Later, after 5 years, you build another floor on it. That is my cost of improvement. Repairs, maintenance, whitewash in general are not my cost of improvement. Those you have to ignore. So I can say any capital nature expenditure on that particular capital asset which is resulting in an additional value would be my cost of improvement. So please be very careful. At your level, you will be given repairs, you will be given whitewash expenses. Do not add it in cost of improvement. Do not add it in cost of improvement. Now, since we are talking about indexation, particular asset can be purchased going back to so many years. It can be a 50-year-old asset or a 60, 70-year-old asset. So the government has done one thing to reduce the calculation, and as per the data which are available, they said that if there is any asset which is purchased, before 1st April 2001, uska value has to be taken as the cost or the FMV, whichever is beneficial. When I say whichever is beneficial to the assessee, think you will take the higher or you will take the lower. You will take the higher amount, because here the cost is a deduction from the net consideration so that your gains can reduce. So which will be the beneficial amount? The higher amount. The FMV of that particular asset on 1st April 2001 or the cost, whichever is lower has to be taken. Whichever is higher has to be taken. My bad. Sorry. Whichever is higher has to be taken. Now for the cost of improvement. Any cost of improvement happened after 1st April 2001 has to be taken as it. But any cost of improvement which happened before 1st April 2001 has to be ignored Why? Because when you will be taking FMV as on 1st April 2001 for the cost of acquisition, when you will be taking FMV as for 1st April 2001 for the cost of acquisition, you would have already considered that improvement part in that FMV. That's why if you are taking FMV as for 1st April 2001, cost of improvement will not be taken. So, any cost of improvement before 1st April 2001 has to be ignored. Any cost of improvement before 1st April 2001 has to be clearly ignored. Clear? Now there is another section, section 55, which clearly states more things. All these cost of acquisition and cost of improvement is given in section 55. Section 45 is my charging section. Section 48 is my mode of computation, how you compute it. And section 55 is how you take the cost of acquisition and cost of improvement. Now in that, it is understood and taken is for your intangible assets. For intangible assets, what would be my cost of acquisition? For intangible assets, what would be my cost of acquisition? For the intangible assets, the cost of acquisition is very simple. They say there can be all these assets like your goodwill, rights of property, and your so many types of intangible assets. But one thing you have to remember, first I'll say for the goodwill thing, only goodwill of business has to be taken as a capital asset and uska cost has to be taken. Goodwill of profession is a capital asset, but uska cost will always be nil. Goodwill of profession is a capital asset, but uska cost has to be taken as nil. Uska cost has to be taken as nil. Always remember that. Just 1 second. Available now. Okay. General में you remember general cost of assets you have to take 1st April 2001 से before if it is purchased, cost or FMV whichever is higher. Then after 1st April जो भी उसका cost है. Clear? Now for the goodwill of business, trademark, brand name. Goodwill of profession is not included. Goodwill of profession the value is always nil because it is said, Srinivasa Shetty ka case है, it is said that goodwill of profession, it cannot be measured because profession is a very personalized thing. So goodwill of profession is not to be taken as a value. Goodwill of business, trademark, brand names, basically all other intangible assets, if are self-generated, the value would be nil. But if have been purchased from previous owner, then the purchase price. So when you transfer the business, उसमें goodwill का value होता है. So that goodwill का value would be the purchase price. But if it is self-generated, I am running a business for 10-15 years. It is self-generated goodwill of business. It is a capital asset, but the value would be nil. The value as in the cost of acquisition would be nil. And there is never cost of improvement in my intangible asset. There is never cost of improvement in my intangible asset. Then for the bonus shares. The bonus shares are those shares which are received for free. That is, you being a shareholder, you get extra shares. So bonus shares, if received before 1st April 2001, usko again you have to take as per FMV on 1st April 2001. But bonus shares which are received after, or I should say allotted after 1st April 2001, uska value would be nil. So all in all, bonus shares values are nil. But when you take up, cost is nil. Now when you take up for the bonus shares which is allotted before 1st April 2001, so you will compare nil cost and FMV on 1st April 2001. Obviously, FMV on 1st April 2001 will be higher. That's why it's said for bonus shares which are allotted before 1st April 2001, FMV as on 1st April 2001 has to be taken. And for bonus shares which are allotted after 1st April 2001, the value would be nil. For the right share, students, right shares, how many you have an idea? Think. The right shares are what? A company offers its existing shareholders a special right. The company offers its existing shareholders a special right at a predetermined price. To make an application into those shares. So instead of going and issuing the IPO, I have existing shareholders. I will go to them. I'll say, you want to purchase this particular share? They will say yes. So I've given them the right. So this is their right shares. So if they subscribe that right, it would definitely be at the predetermined price. So suppose in the market, the price of that share is 150, but I go to them and offer the share at 120. Now, it is just a right given to him. It is not shares which have been allotted. They will exercise it. If they exercise it at that 120 price, that means they are ready to purchase it at 120 price. For them, the cost of acquisition would be 120. But if they do not want to exercise it at 120, they say, I do not want to exercise my right. So shares have not been given, the value would be nil. But if they announce the right to some other person, now, so I have me to whom the right share price was given at 120. Now I know that Mr. X is very much interested in these shares. So let's make a profit. I have this right shares. I have not exercised the right, but I have this right to exercise the right at 120. I offer him that you take this 130. I'll give you this right where you can take 120 ka share, but for that you have to give me 5 per share ka value. That means for me giving the right to you, here the assets you have to see is not the shares. Here the assets are the right of that share. That means for me giving you the right of that particular share, give me 4 rupees per share. So he's in profit. Market mein wo price kitna hai? 150. He's getting it at 120 plus 4 rupees extra. So 124 mein anyway he's at the benefit side, correct? For me, 3 things happened. First, I already had shares, they are untouched. Usko jis cost pe I purchased, that would be that. The right shares, if I subscribe them, if I use my right, so for whatever value I have taken those shares, that would be my cost of acquisition. I am not using my right, I re-announce that right. So now, I re-announce that right, so that 4 per share which I have received is what? Is covered as a transfer of relinquishment of asset. That is relinquishment of assets. So that 4 rupees which I have received, the 4 rupees which I have received is full value of consideration. But for what I have received, for the right I have received, but for right, what is the cost? Nil. The right which I gave up, the right which is transferred, the right is a capital asset here. The transfer has happened. For that, what is my cost? I did not purchase anything for that. I did not pay anything for getting that right. That right, my value is 0, but I got 4 per share, so 4 per share would be my capital gain. So this person, who is Mr. X, who actually acquired the shares by giving 120, which was the right price, and also by giving 4 rupees, that is 120 plus 4, for him the cost of acquisition would be 124. But take a moment and listen, give it a read. At your level, again I'll say, it's a bit technical, but on a bad day you can have a question like this. Take a moment, it is not tough, but there are 2 people and give a moment to read it. Puneet, indexation values will be given in the question. Durga, Nandini, the index cost of acquisition, you do not do it for short-term capital assets. Do it for long-term capital assets, but you don't do it for bonds and debentures. There are more things for which indexation is not there. It would be summed up later. Okay? Then, STT Sakshi, STT ka deduction you never claim. That means even if as a transferor paying the STT, it is not a transfer expenses. So STT deduction is not claimed. And if as a purchaser you are paying the STT, you will not, even if it is direct transfer expense, it will not be added in the cost. Malvika, for the bonus shares issued on or before 1st April. Now first thing, what is my bonus shares ka cost? Nil. For any asset which is issued before 1st April 2001, what do you do? Cost or FMV, whichever is higher. Cost is nil, FMV is obviously higher, FMV on 1st April 2001 would obviously be higher. So that means you have to take the FMV. So hence for any bonus shares which are issued before 1st April 2001, you will be taking the FMV of 1st April 2001. So right shares which are purchased by the person in whose favor the right is re-announced. So this is from the point of view of Mr. X. Mr. X ने मेरे को 4 rupees दिए, he gave me 4 rupees, correct, and he also gave 120 rupees for that special price. So for him, share price, cost of acquisition would be purchase price, which is 120, purchase price paid to the renouncer, which is 4 rupees to me, as well as the amount paid to the company for allotment. So 120 plus 4, 124. Here. Okay, great. So now we move forward. I hope the concepts are clear. Now we move forward to very interesting thing. Coming back to section 45 itself. Coming back to section 45. 45(1) ka general rule, what did I tell you? There is a capital asset, transfer of capital asset, and capital gain is taxed in the year of transfer. But there are 4 cases in general. 4 cases which act as an exception. Act as an exception means that the capital gain would not be taxed in the year of transfer. The capital gain would not be taxed in the year of transfer. Sure, Mohit, I'll definitely take. Sundari, I'll do it once again. Manoj, you can just give it a refreshment, and if others are also facing any audio video lag problem, please tell us so that we can do it off, correct it at our part. Okay. So I was saying section 45. I'm not running, I'll definitely do it, okay? So section 45 subsection 1 says the capital gain is taxed in the year of transfer, but there are 4 general exceptions in section 45 subsection 2, subsection 5, subsection 1a and subsection 5a, which says, please listen carefully, very interesting concept and this is a definitely question will come, which says that capital gain will happen in the year of transfer. The capital gain will happen in the year of transfer, but it will be charged to tax. It will be charged to tax in a different year. That means transfer has happened, but you will offer to tax. That means apni return mein you will show in a different year. How? First section 45 subsection 1a, which talks about suppose an asset which is destroyed, damaged, due to flood, hurricane, cyclone, earthquake, or any civil disturbances, war, fire, explosion, or any act of enemy, due to which you will receive an insurance amount. Suppose a particular building gets destructed because of fire, or so it doesn't happen, okay? Now, that is my capital asset transfer, extinguishment of right, khatam ho gaya asset. Okay? Now that asset has gone. But what is my full value of consideration? It would be the insurance claim which I may receive, right? Which I may receive insurance claim. There are so many uncertainty. The amount to the period by which it will be received. Suppose in 2008 1819 a building was bought, but uska insurance claim was received in 2019-20. The asset has been transferred. The transfer happened in 2018-19, but you will offer it to tax only the year in which you received the insurance amount. So if you have a notepad, quickly make 2 columns like these. Write here section. Write here year of transfer. Sorry for bad. And write here year of taxability. Transfer for insurance wala would happen when the asset got destroyed, right? Which in this case is this year 1819. But taxability will happen in the year when the insurance claim is received. Because insurance claim is one such thing which is very uncertain. Right? The year when the insurance claim is received, that would be my year of taxability. Now, when I say this, I am just deferring the taxability. I am not changing my calculations of taxability, which we understood in section 48. So, here, holding would be from the period when that building was acquired till the year it was destroyed. Okay, period of holding to see short term, long term would be till the year it was destroyed, not in the year of taxability. My indexation will also happen taking the year of destroyed as numerator and the year of acquisition as the denominator. Only the relevance of this year is just to defer the taxability so that the full value of consideration can be known, which is in this case is the amount. Is it clear? Yes. Now, this is my first exception. General rule is taxability happens in the year of transfer, but here year of transfer is the year when it is destroyed, and year of taxability is the insurance claim receiving year. Then another very important and very interesting and everyone's favorite section, section 45(2), which talks about conversion of capital asset into stock and trade. Conversion of capital asset into stock and trade. Uske liye my year of transfer is the year of conversion. Very good. But the taxability is deferred to the point when this stock and trade is actually sold. When this stock and trade is actually, suppose I converted my jewelry capital asset into jewelry business asset, which is my stock and trade. Okay, in year 17-18, but I only sold that piece of set in year 2019-20 previous year. So now how will I calculate the capital gain? Cost I know, with the cost at which I purchased that jewelry. Okay, I know that. Into indexation ke liye, which year I will take? I will take this year. I will take this year as my year of transfer upon my year of acquisition, not this year. This year relevance is only itna that here you will just make the taxability deferment. You will calculate the gain assuming the year of transfer as the year of taxability. If you remember this rule, you do not have to remember anything in particular. Do not ratify again, say, just open the mind and see that this is just a deferment of taxability, not a deferment of computation of capital gain. You are computing it as if you are offering it to tax in this year itself, but only the deferment of capital gain happens. But ma'am, it's just a conversion. What did we get as a full value of consideration? Cost, so we know that we acquired it, that jewelry for this much amount. But what is my full value of consideration? My full value of consideration here is FMV on date of conversion. This is very important from IP intermediate point of view. This will come as a question. Please focus on it. FMV on date of conversion. conclude two things. When the stock in trade is sold, students do one thing very simply. They compute the capital gain क्योंकि section 45 subsection 2 सबका सबसे important section, they remember that. But they don't show the business income. When the stock in trade like this, a converted stock in trade is actually sold, there would be two incomes in that particular year. One would be my business income, which would be sale price minus purchase price. I'll come to that. Another is my capital gain income. Another is my capital gain income, which I told you how to calculate. And how to calculate the business income? Now think from the business perspective. Think from the business perspective. I know the sale price for which I sold it in the market. For me, the purchase price is same, the FMV on date of conversion. Cost for me is the price for another. Correct? See students, whenever a capital gain question comes, you have to do quickly four things. Identify capital asset, identify the transfer amount, see whether you have been given cost of acquisition or not, see what is the case, whether you have been given the sale price or full value of consideration or not. And quickly open your mind to it and just do it. It would be easy to understand. But open your mind to the case. Then next deferment also happens when in my section 45 subsection 5, which talks about compulsory acquisition of an asset. Compulsory acquisition, what happens? Government says we have to make a road from here, please. You have to give us that building, we'll give you the compensation for it. Compulsory acquisition, you get the compensation. Now since it's a government thing, delays are bound to happen. A particular property may be acquired in 1 year, but you may receive the amount in a different year. So in case of compulsory acquisition, my year of transfer would be the year of compulsory acquired. Here when it is compulsorily acquired. My year of taxability would be when I receive the compensation. When I receive the compensation. Year of transfer is my compulsory acquired year. So it is compulsory acquired in 2016-17, but I received the compensation only in year 2019-20. So the taxability again defers to 2019-20, but you have to calculate it as if everything has happened in this year itself. Clear? Yes, no? Okay. And again, full value of consideration is the compensation amount. Question comes here, student, is, I think what is a small part in small language. Here question comes, compensation generally is not received in one go. It may be received in lump sum, but sometimes it is received in installments. That means an asset which was compulsory acquired in 16-17, uska compensation was decided as 30 lakhs. But in 1920, I only got 15 lakhs as an installment amount. Only got 15 lakhs. Whether we have to give the taxability only to the extent of 15 lakhs and you have to proportionate? No. The moment first installment of compensation is received, the moment the first installment of compensation is received, I repeat again, full capital gain has to be offered. Full capital gain has to be offered. The moment first installment is received, full capital gain has to be offered. But this thing is different when it comes to stock in trade. Stock in trade, I told you, conversion of capital asset into stock in trade, you have to offer it in the year when the stock in trade is actually sold. But if the stock in trade is sold in parts, like I gave an example of jewelry, the whole jewelry set was transferred, but only the earrings of it were sold, the necklace is still unsold. So then in that case, proportionate capital gain is offered. Your compensation, even if in a single installment is received, in the year when the first installment is received, full capital gain has to be offered. Here you take it proportionate. This is a very typical case which can come, but again, first make your concept clear on this and then do it. And I'm again saying, no matter how much lectures you attend, renowned professors come, till the time you will not practice, till the time you will not make yourself notes and make an understanding, practice questions as much as many papers you can. Okay, and again make your concept clear. These are the three cases, and the other is a joint development agreement. This is more important from final level, but I'll quickly give you an explanation how this happens. What happens generally, students, people have properties, they have dadas and all ka property, but they do not have the time to build it. So what happens is they make an arrangement with a builder, generally called the joint developer, who takes my property and takes the onus of building it. उसको क्या benefit होगा? He will of this land, he will make 6 small flats, okay? And as a consideration of me giving my land to him, and because of he's now devoting the time, putting all the raw materials and stuff, he will give me the consideration of that land as 2 floors and some cash, and he will keep the remaining with him, and then he will sell it. Generally, this happens a lot in North India because there are house building system here. Okay, so there's a building. I am the owner of that building. I give it to the builder, the joint developer. So the moment I transfer him the possession is my year of transfer. The moment I transfer him the possession is my year of transfer. The year of taxability would be when the completion certificate is issued for that property. When the completion certificate is issued for that property would be my year of taxability. For me, who gave him the land, I got 2 flats. So the stamp duty value of 2 flats would be my full value of consideration. क्या क्या रहा है? I had a small land, and some all 1 floor ka house in it. I gave up that, and I got what? I got 2 well-built flats along with some cash. The asset which is given up is land. So year of transfer for that would be the possession giving. Completion certificate when is issued is when I will make that capital gain transfer taxable. And for me, the full value of consideration for giving that land is I got 2 flats plus, if any, cash. So these are the very 4 exceptions to general rule. Otherwise, you always take the year of transfer as the year in which the capital gain has to be taken. But in these 4 cases, the year of taxability is different from the year of transfer because of very genuine situations involved. Now students, before I go to another thing, one question can come from enhanced compensation compulsory acquisition. Suppose you're not happy with the compensation, you make an appeal, get an order in your favor, and then you get the enhanced compensation. Enhanced compensation means compensation over and above what was decided. For the enhanced compensation, what is that income? That is income is also capital gain. That income is also my capital gain income. The full value of consideration mein, you will take enhanced compensation ka amount, right? But how do you calculate capital gain? I told you reduce cost of acquisition. But what you will reduce as cost of acquisition? Nothing. You know why? In case of enhanced compensation, you will not reduce anything from the cost of acquisition. Why? Because cost of acquisition has already been claimed as deduction once when you had offered first compensation received pay the amount. So here you do not have to take any amount of cost of acquisition when you are calculating capital gain for enhanced compensation. When you are calculating the capital gain for enhanced compensation, only deduction which is allowed is litigation expenses. Clear? Okay, some interesting question. Pranav says, what if we get no cash and only flats? Then okay. Then an stamp duty value of those flats, but stamp duty value on which date? Stamp duty value on the date when the completion certificate is issued. Sanju says, ma'am, how will we calculate business income when stock in trade is sold? Now, coming to the business income, think yourself as business. You got that stock in trade at what price? You did not pay the price, but capital asset का full value of consideration क्या लिया आपने? FMV on date of conversion. So for him, for the business, the cost would be the FMV on date of conversion. It is immaterial, Pranav, even if the stock in trade is sold after 2 years or it remains unsold for many years. Till the time that stock in trade is not sold, you will not offer the taxable capital gain income. Why it happens? Because they say that till the time you have not realized something, we cannot take the tax from you. Okay? You did not receive any money. You are the same assessee. You converted it. Till the time you do not realize anything from it, we will not take the tax from you. The cost of the person who re-announced the right will be nil. Yes, the right ka cost would be nil. Okay. There are 2-3 more sections in section 45, 2 sections more, which you have to remember. Very simple, can come as an MCQ. Section 45, subsection 3, which talks about when a partner transfer a particular asset to a partnership firm, or a member transfer a particular asset to an AOP. Us case mein the full value of consideration would be what? I am a partner. I transferred you. You are a partnership firm. Both are different tax entities, right? I transferred you the particular asset. Okay, for that full value of consideration, even if I have received anything, that would be ignored. My full value of consideration would be the amount at which the partnership firm recorded in books. The amount at which the partnership firm recorded in books. And vice versa case mein, that means if the partnership firm transfers something to the partners, which is section 45 subsection 4, us case mein, the full value of consideration for the partnership firm would be the FMV on date of transfer. Would be FMV on the date of transfer. This is simple. So when a partner is transferring something to the partnership firm, full value of consideration would be the value at which the partnership firm recorded in the books. When partnership firm transferred to the partners, full value of consideration for the partnership firm would be the price, would be the FMV on date of transfer. Here? Okay. Now, for you and for everyone, when a capital asset is converted into stock in trade, is it a transfer? Yes, we read it in the definition of transfer. Correct. But transfer has happened when the conversion has happened. But the taxability is deferred to the year when the stock in trade is actually sold. When the stock in trade is actually sold. Why? Because income tax wants कि आपके हाथ में there should be some money to give the tax. This asset has not been realized in real terms, so we will not take the tax. Okay? So till the time that stock in trade is actually sold, you will not offer that income to tax. But having said that, in all these 4 scenarios, the year of taxability is only a deferment of the taxability, not the deferment of computation of capital gain. Your period of holding, your indexation, everything would be considered till the year of transfer. Till the year of transfer, but it will be shown in the year when stock in trade is actually sold. Now stock in trade is sold, that means question mein there would be a capital gain income also and there would be a business income also. Business income would be what amount? Sale price minus purchase price. Sale price to business ke liye, you know the price at which you sold it in the market. But purchase price for the business would be the consideration price for the capital asset. Simple. Here, cost for one, the sale price for another. Sale price, full value of consideration, capital gain, I took the FMV on date of conversion. For the business, the cost would be the FMV on date of conversion. Here. Five, 5 minutes, just 5 minutes. Great, great. Okay, interesting question, Tabassum. Stock in trade is converted into capital asset. Now, until 2 years back, this concept was not there for the taxability. This concept was not there for the taxability. Until 2 years back, stock in trade conversion was not there in any head. But section 28, which is the charging section of PGBP income, that means if a stock in trade is converted into a capital asset, stock in trade is converted into a capital asset, that means now I'm the jeweler. I had beautiful set as a stock, but I thought it is better that I should give it to my mother. So I converted into my capital asset. The moment conversion happens, of that stock in trade into capital asset, it is a business income. It is a business income. The business income would be how? Sale price minus purchase price. Sale price, I don't know because I just converted it. Purchase price, I know. Purchase price is the price at which obviously I purchase it from the dealer. The sale price again in this case would be the FMV on date of conversion. Would be FMV on date of conversion. Clear? And purchase price, so we know. So one, business income will happen. And now for the capital asset, a capital asset है आपके पास. Whenever you will transfer. But till that time, for you, the cost of acquisition is the FMV on date of transfer. Clear? Now, students, we'll take a quick break. Or should we do 50C? Okay, we'll take a quick break, but we'll resume it maximum by 8:15. Maximum by 8:15 we will resume it. After the break, we'll be doing first 50C, 50B, slum sale, and my 50C, everyone's favorite section. And then we'll go to the exemption parts and the taxability parts. We'll cover up your capital gain. Okay, so quickly, sharply by 8:15 we'll be back. We'll be covering up our capital gain, got remaining part. Meanwhile, take a break, drop your questions. Girish sir? Yes sir, yes sir. Okay, so welcome back to the after break class. So I hope I have got some few questions. I'll quickly take it before we go to the next topic. Very quick on some few questions. Enhanced compensation, a student always remember that enhanced compensation means compensation over and above the enhanced compensation. So you have already must have offered the taxability of compensation, original compensation. While offering original compensation, you had already claimed your original, your cost of acquisition once as a reduction. You will not claim it as that deduction again. Why? Because cost of acquisition has already been claimed as deduction once, and it can be only claimed as once deductions go. You cannot take twice. So enhanced compensation case में every full enhanced compensation would become taxable net of litigation expenses. Litigation expenses means because you will not get enhanced compensation sitting at the home. You will definitely file a court appeal and then there would be a settlement stuff. So that is my litigation expenses. Then there is a question regarding FII. Very good question, Isparya. FII को why stock in trade is taken as the security which is held as stock in trade is a capital asset. Yes. For the institutional investor, there are only securities through which they invest in India. Okay? So for them all, and for them their securities are always stock in trade, but it is clearly mentioned in the Act that these securities will not go as business income, will always go as a capital gain income for an institutional investor. But if you, me, are holding shares as stock in trade, for us, that would be my stock in trade. But only in case of foreign institutional investors who have only sole purpose of investing in India and they do it by securities, for them, it is clearly written in the Act that even if the security is a stock in trade, it will be a capital asset. Then we just had a question, if security deposit is received in joint venture agreement, which will be adjusted at the time of agreement, done at completion date, so which year it will be taxable? We just see, taxability again will happen only in the completion certificate time. You may receive some amount or you may be receiving some amount in some years, but the taxability will go till the time that joint development agreement may that property is completed and certificate of completion for your flats, which will be given you as a consideration, is issued. Okay. Jyoti, there's this question. Jyoti, see, always when we say income always include losses. Income include losses. The mode of computation which we discussed, full value of consideration minus cost of improvement, will result not always in gain, it may result in losses also. So that's not an issue that if you're making a purchase of, the building is of 5 lakh but you received only 4 lakh, then there's a loss of 1 lakh which would be allowed to be set off in the coming year. So there is a short-term capital loss or long-term capital loss. Clear? And for simple thing, when taxability of stock in trade as capital asset, I'll come to that part just the next thing which we'll be doing is that one. Okay, then I believe I've done it. Always remember, see, conversion case में do not get confused. See what is going and when it is going. Take the FMV on that date. When you're calculating capital gain, assume that you have a capital asset in the hand and solely assume only that. Don't forget that there was a stock in trade which is sold. When you come to the stock in trade, see at what price it is sold, at what price it is received. Okay? And you will always get the things clear. There is very rare case when there is a reduction in compensation, very rare this happen, because government will not make a claim and you will make a claim only when you are very much sure that there is an enhancement. Okay? Amendment note, students, it's better you refer to RTPs. I think they are wholesome. Refer your modules, everything is there. Whichever book you are referring, but do not forget, I'll just say do not forget do questions from your modules and RTPs and mock test papers. These are important to give you an insight of what the pattern of questions will come. Okay, so now quickly coming to the next part. Now we've understood what is transfer, exceptions to the general rule of transfer. We understood capital asset, we understood transfer, we understood computing, how do we compute, we understood section 55, the cost of acquisitions and cost of improvement. And now we come to the things which are not transfer, things which are not treated as transfer. So section 47 talks about the transactions which are not considered as transfer. Section 47 is a really important section, but if I say the importance and understandability comes at a final level. At your level, there are certain transactions which you remember that these are not transfer. That means even if the assets are changing, even if there is sale happening, even if the transfer ka definition में transactions are happening, but still then also it will not be considered as transfer. Then also it will not be considered as transfer. First thing is very common which you have to remember is any distribution of capital or assets on total or partial partition of HUF. When an HUF is partitioned, now the individual will get the assets of that HUF, the individual will get the assets of that HUF, even if now the assets have been transferred from the HUF to individual, it is not a transfer. That means HUF will not offer capital gain on that particular part. HUF will not offer capital gain on that particular part. Why? Because it is not a transfer. Even if it's a capital asset, but it is not a transfer. Anything which is given as gift, will or revocable or in an irrevocable trust is not a transfer. Someone asked me at the beginning of the class, if I am giving a gift as a transfer, answer is no. It is specifically given in exempt transfer under section 47, which says that giving of gift is not a transfer, but yes, there is an implication in the hands of the person who receives the gift. So if I give a gift to Mr. X, there has been a transfer, my asset has gone from me, but I will not show capital gain. Okay? But for Mr. X, it would be a gift income which will be taxed in other sources. Be a gift income which will be taxed in other sources. So you have to see the transferor and the transferee. Transferor ke hand mein it will not be a capital gain. Why? Because it is an exempt transfer. Similarly, when 100% subsidiary transfer any assets to holding company or holding company transfers any assets to the Indian company, to the 100% subsidiary company, it is not a transfer. Holding to subsidiary or subsidiary to holding is a transfer, but wholly owned subsidiary transferring anything to its holding company or holding company transferring anything to its wholly owned subsidiary company is not a transfer. Here you have to remember the transfer should be an Indian company. Simple merger amalgamations में what shares you receive, these are not transfer. Ma'am, कैसे? T. Amalgamation, you understand? There was a company X now which got amalgamated and now there is a company Y. X company got amalgamated. You as a shareholder would have X company ke shares, but now that is amalgamated, you will get Y company ke shares. So X company ke shares are gone, but then also it will not be a transfer. Even as a consideration, you have received a Y company share. So any of shares in amalgamation is not a transfer. Is this important to remember? Important to remember a few things which I'll tell you. Gift is not a transfer. Giving something is not a transfer. Then conversion of debentures into shares of that particular company is not a transfer. Conversion of debentures into shares of that particular company is not a transfer. Conversion of preference shares into equity shares is not a transfer. That means conversion means you have not invested anything. anything further, that you were holding preference shares of company X. You were holding preference shares of company X. Now, as per the provisions, they got converted into the equity shares of company X. Now, preference shares of company X are gone. But if I ask as an income tax authority, I will say you had a preference shares of X. What happened to that? You said that was converted into the equity shares. Is it a transfer? No, it is not a transfer. Conversion of preference shares to shares is not a transfer. But when I will sell that equity shares further, it will be a transfer. That conversion, changing of the asset or changing of the assessee or happening any transaction will not be a transfer, which if it is covered in section 47. I'll say again, in 2 clause 47, section 2 clause 47 definition section covers the transactions which are transferred. Section 47 covers the transactions which are not transfers. That means even if the capital asset has gone from you, assessee has changed, everything has done, but it is an exempt transfer. That means if such transactions happen, the transferor will not pay the capital gain. At intermediate level, remember, giving of gift is not a transfer. Conversion of bonds, debentures into shares is not a transfer. Preference shares conversion into equity shares is not a transfer. Partition of HUFM, if you receive anything, it is not a transfer. For the transferor, there is no capital gain. Now coming to the person who receives it, that is the transferee. Mr. X sold it to Mr. Y. Not sold it, but actually gave it as gift. So Mr. X gave his house as gift to Mr. Y. Mr. X gave his house as gift to Mr. Y. For Mr. X, no capital gain. Perfect. For Mr. X, no capital gain. But for Mr. Y, it is a gift which is received, which would be taxed as from other sources. Clear? Now, when Mr. Y will actually make a transfer in a market to this, Mr. Y sold this building to Mr. Z. Mr. Y sold this building to Mr. Z for a value of 40 lakhs. Now, Mr. Y के hand में it is a capital gain because it is not an exempt transfer, it is a normal transfer. Mr. X के hand में it was not a capital gain. Why? Because X transferred this to Y as a gift, which is an exempt transfer. So Mr. X के hand में no capital gain, but Mr. Y के hand में it is a gift as per income from other sources. I am ignoring away this. Okay? Here the transaction is finished. Now, when Mr. Y will actually transfer it to Mr. Z and he sold it for 40 lakhs. Full value of consideration is 40 lakhs. Question comes for the cost of acquisition and period of holding. For the cost of acquisition and the period of holding, the period of previous owner has to be taken. Period of previous owner has to be taken and the cost at which the previous owner acquired would be my cost of acquisition. Now I am talking from the point of view of Mr. Y. Mr. Y के लिए cost of acquisition वैसे तो he received it from gift का केस छोड़ के let's take under a bill. Okay. Gift के केस में suppose Mr. X and Mr. Y were father and son. Mr. X father gave it to Mr. Y. Mr. Y के हाथ में it is a gift, but it is an exempt gift. Now, when he transferred that to Mr. Z in an open market for 40 lakhs, him cost of acquisition, full value of consideration is 40 lakhs, this is clear, but for him, cost of acquisition would be the cost to the previous owner. So, if Mr. X had acquired this property for 3 lakhs, so for Mr. Y, cost to the previous owner, which is 30 lakhs, would be the deemed cost of acquisition as per section 49. be deemed cost of acquisition for Mr. Y, which would be the cost to the previous owner. And period of holding has to be taken from the date when the previous owner first acquired it. So if the previous owner had acquired it on 1st April 2015 and he transferred you on, he gifted you on 1st April 2018 and you transferred it on 1st January 2020. So now, if you will compare these, you will say, ma'am, it is a short-term capital asset because immovable property 24 months time period. I will say no, because Mr. Y acquired this asset through gift, so the period of holding of the previous owner also has to be included, and the cost of the previous owner would be the deemed cost of acquisition for Mr. Y. That is, from 1st April 2015 to 1st January 2020 is definitely crossing 24 months. It's a long-term capital asset. And indexation will happen for Mr. Y as cost of acquisition 30 lakhs, year of transfer which is 1920, CII divide by 1516 ka CII. Clear? Divide by 1516 ka CII. Any doubt up till now? First focus on this and definitely come to your other doubts. Okay. Chandan Gupta, can you please tell what is the problem you are facing so that we can resolve it? So feature pe I will come, karta feature dial, there is only one minor left in the HF, then can minor be able to receive the property of deceased karta? This is not a capital gain question. Okay. Ma'am, suppose my father gave me an antique painting which was purchased long back and I'll come to Manjula, I'll transfer it today to some person in ABC, then how will we decide the period of holding for the previous owner? See, previous owner, the concept is the person who actually acquired it by a price. Suppose Mr. X ko bhi, he acquired it from his father, that is, by his grandfather say, he did not pay the price. Acquired from his grandfather for 20 lakhs and he did not pay the price. So here also in this case, cost of acquisition, here also in this case, Mr. Y, same question remains the same. Mr. Y received the asset from Mr. X, but Mr. X had received the asset from Mr. A, who actually paid the cost of acquisition for 20 lakhs. For Mr. Y, now the cost of acquisition would be 20 lakhs and the period of holding will reckon from 1st April 2002. But there are two approaches. One approach says that indexation actually starts from the period which is first held by the assessee, but the period which is first held by the assessee, but you can take the other approach, which is this approach, that we will take it by the period of holding would be the period from which the previous owner held it. And by previous owner, we mean the assessee or the person who actually paid the price for that particular asset, who acquired it for mode other than the exempt transfer. To simplify, who acquired it from the mode other than the exempt transfer. try, but as a protocol, we've been asked to say it in English. Clear? So the cost to the previous owner and your period of owner. Exempt transfer section 47, which talks about transfers which are not to be offered to capital gain. This way you have to remember gift, will, conversions, reverse mortgages. Here the transferee के hand में the cost of acquisition would be the cost to the previous owner, and the period of holding has to be taken from the period of the previous owner, Clear? There's some question. If the previous owner is not known, this is something practical thing, but in questions you would be given cost to the previous owner, you would be given everything provided, and always remember, if the previous owner purchased it before 1st April 2001, do not forget it to compare it before the price with the FMV. First take the cost of acquisition, compare it with the FMV, and cost of acquisition would be the price with the previous owner. Clear? J. Shah says that taxation should happen taking the numerator as the year in which the assessee first held it. You can take the numerator as the year in which the previous owner first held it, but whatever you follow, you have to write it in the exam that we are following it as per this approach. Now we'll bug up the class because we have taken up quite a few doubts and we will lag behind otherwise. Coming to standalone sections, section 50C is a very, very, very important section. See, student, what happens is we make a sale and avoid the gain amount. To avoid the gain, we show the sale consideration much lower than what it actually is. People should not take the benefit of it. Section 50C was introduced and there was an amendment which came that if the stamp duty value, this is only for immovable property. First of all, this section is only for immovable property. So if the stamp duty value is more than 105% of my sale consideration, then stamp duty value would be considered as full value of consideration. Meaning thereby that if you act smart and you show that your sale consideration is 10 lakhs, but actually the stamp duty value, that is the registry value of that, is 30 lakhs. You just showed it as 10 lakhs so that you could avoid the gains. But the authority will take stamp duty value as per section 50C by full value of consideration, which is 30 lakhs, and on 30 lakhs they will calculate the gain, not on 10 lakhs, But if that stamp duty value is within 5% range of my full value of consideration, then it has to be ignored. Why this 5% bracket came? This 5% bracket came as a genuine case that okay, always my full value of consideration will always not match my stamp duty value. There can be something up and down. So if you sold it for 10 lakhs, but the stamp duty value was 12 lakh. Sold it for 10 lakhs, stamp duty value was 12 lakh. What would be my full value of consideration? 10 lakh. What would be my full value of consideration? 10 lakh. It would not be 12 lakh. Why? Because it is not crossing 105% of my sale price. But the moment it crosses 105% of the sale price, stamp duty value would be considered as my full value of consideration. This is what section 50C says. Next thing is very important you have to remember is that if you are not happy with the stamp duty value authority, that means stamp duty authority say, registry value say you are not happy and you claim that I am a genuine case and because of the market was down due to lockdown and because of so many scenarios, I had to sell the property at a very low price. You will go to the valuation officer, you will go to the assessing officer, he will refer your case to the valuation officer. Valuation officer will determine the value, and if it is less than the stamp duty value, it would be your full value of consideration. It would be your full value of consideration. That means you always have an option to oppose the stamp duty value, and you can go to the authority to value it. Okay, so 50C simple stamp duty value crossing 105% of my sale consideration be my full value of consideration. Next is my section 50B, which is very important, which is my slump sale. Slump sale is when you sell the division or the undertaking as a whole. You sell a division or an undertaking as a whole. I am a business unit. Business assets are capital assets, we know. I am a business unit. I sold the undertaking as a whole. That means there was two undertaking, undertaking A and undertaking B. Undertaking A को मैंने पूरा sell कर दिया. What will attract? Capital gain will attract. How will it attract? As per section 50B, slump sale. Question can come as per section 50B, slump sale. उसमें how will you show? Sale consideration to we know. Sale consideration to we know. It is very simple. Sale consideration will be my one second. Sale consideration. Suppose I sell my undertaking to XYZ company. They gave me 50 lakhs for it. Okay. But what about the cost of acquisition? Now, एक undertaking में there is not just one asset. So many assets. There are book assets like debtors, then there are depreciable assets, then there are non-depreciable assets. Full balance sheet, full unit you sold, full division you sold, and you got a lump sum payment. Ab lump sum payment mein you don't know what amount is for what thing. You only know that there is 15 lakhs which are received for the whole undertaking. So how will I calculate the capital gain? So sale full value of consideration, which is the price which you received, less transfer expenses, net consideration, less cost of acquisition. Now cost of acquisition would be the net worth at the time of transfer. Net worth. Net worth, so how will you calculate? Simple. Net worth कैसे निकालते हैं? Assets minus liabilities. Assets, how will you calculate? The depreciable assets, so you will take it. Depreciable assets, so you will take it at written down value. Non-depreciable assets, so you will take it at book value. Revaluation, so you will ignore. So if any asset is revalued, that amount would be ignored, meaning thereby, so if the asset value was 10 lakh, but it is revalued to 11 lakh, you will take 10 lakh. You will not take it 11 lakh. And you will reduce it from the liabilities, as simple as that. Now question comes, ma'am, whether it would be a long-term capital gain or a short-term capital gain, because this thing can happen. A particular asset may have been purchased 2 years back. One asset would have been purchased 1 year back. Some assets are 10 years old. So you have to see as an undertaking as a whole. If that undertaking is is held more than 36 months, it's a long-term capital gain. If it is held for less than 36 months, it is a short-term capital gain. So undertaking a time period you have to see, not a particular asset ka time period. Some still a very easy question will come. Balance sheet would be there. Just focus when the undertaking begin. Take depreciable value, written down value for depreciable assets, book value for the other assets, less liabilities, ignore revaluation. I'm saying again and again. Okay. Next come 50C done. Next we come to section 51. It is very, very, very important. Section 51 talks about the forfeiture. Many times what happens, these do not get forfeited. I make an arrangement with Mr. X that I will sell it particular house for 40 lakhs. But somehow, when you fix a deal, earnest money is given. He gave me 5 lakhs as the token money, but somehow the deal did not fruited into, and I forfeited the amount of 5 lakh. Not transfer the asset? No. Nothing happens, but I have received the money. Receiving the money is an income. So if that forfeiture happens after first 31st March 2014. So after 31st March 2014, then the amount is directly treated to income from other sources. Then the amount is directly treated to the income from other sources. But if that forfeiture happens, had happened before 1st April 2014. If that forfeiture happened before 1st April 2014, then what we will do? वो तो question आएगा नहीं? No, it will happen. See how. I made an arrangement in 2013-14 with Mr. X that I will sell a property for 40 lakhs. He gave me 5 lakhs. I forfeited that. Now then I changed my mind and I did not sell the properties for a year. Now 13-14 में clause क्या था? 5 lakh को other sources treat नहीं करना था. 5 lakh को had to be treated as a deduction from the cost of acquisition. Now, when in 1920 I sold that house for 60 lakhs, on the cost of acquisition, I will reduce the forfeited amount and then I will index it. And then I will index it. And then I will index it. So simple. Remember, any forfeiture which has happened before 1st April 2014 has to be reduced from the cost of asset, and then the indexation will happen. Not before, not after indexation, but before indexation. And any forfeiture would happen after 1st April 2014 has to be directly taken to the other sources. Income. आपको question आ सकता है that in previous year 1920 Mr. X sold an asset to Mr. Y for 40 lakhs, but before also he tried to sold the asset. One time in 2012 to Mr. J, another time in 2015 to Mr. Z. J say he forfeited 2 lakh rupees, Z say he forfeited 3 lakhs rupees. 3 lakhs which had forfeited from Z, which happened after 1st April 2014, would have already been shown in the other sources income in the year of forfeiture. But the amount which he forfeited from Mr. Z, while calculating the capital gain in 1920, will be reduced from the cost of acquisition and then indexation will happen. Clear? Two types of forfeiture can come in one single question, and you have to be very careful that 1st April 2014 के बाद वाला would already have been shown in that particular year in income from other sources. I only have to consider the one which is before 1st April 2014 in my capital gain computation. Clear? It's a very good question. Slump sale ko, there is never an indexation benefit. So another thing which will never be indexed after bond and debenture is my slump sale. Slump sale pe there would be no indexation. Slump sale pe no indexation. Clear? Jyoti Kumari, for that cost of acquisition would be nil. Or if you can determine the value, because it's not a self-generated asset, but if you can determine it, then fine, otherwise it would be nil. Next we come to the exemptions. Now we know full value of consideration, less transfer expenses, net consideration, less cost of acquisition, net capital gain. You do not end it here. You always get a right to this is simple. Yes. You always get a right to claim exemptions. Deductions are the one which is given after all heads of income are computed. Exemptions come in particular heads. One such exemption from capital gain at your level, you have hardly 6 exemptions to remember. Till the time you're computing capital gain, forget it. The exemption would only be given when you reinvest into some other asset. The first exemption which is covered in section 54. Section 54 is only an exemption which is given to individual HUF when they transfer a residential house on which there was a long-term capital gain and purchase another house property. When they transfer a residential house and purchase another house property. Now, another house property thing is not a small decision. It cannot be immediately made on a transfer of one. you have to think, correct? Are given a time period from the date of transfer. Either you can purchase 1 year before, either you can purchase 1 year before, or you can purchase 2 years after the date of transfer, or if you do not want to purchase it, you can construct up to 3 years from the date of transfer. So, +1, +2, -1, +2, +3. That means either you can purchase it before 1 year from the date of transfer, or purchase it 2 years after, or purchase or construct 3 years after the date of transfer. So construction के लिए there is a longer time, purchase के लिए -1, +2. Okay, then only you will get the exemption amount. Exemption amount would be the cost of the new asset, but it will not result in the loss. That is, the maximum exemption would be the capital gain or the cost of the new asset, whichever is lower. Now, here is an important amendment which came in section 54. Earlier, you were only allowed to make an investment into a new house only a single time. That means, suppose I had a gain of 1 crore. I am talking about the net gain. And I purchased a residential house of 250 lakhs ka value. Now, 50 lakhs ka value ka I purchased a residential house. It was my need to purchase a small house. Now, earlier, only you could purchase one single house from that gain to exempt. With effect from previous year 1920, you are allowed to make investment in 2 houses and claim the benefit of the 2 houses as the exemption, and claim the benefit of 2 houses as exemption if and only if the value, if the total capital gain, if the total capital gain is less than 2 crore, then only you can take the benefit of investment in 2 houses. Otherwise, investment in 1 house. That means if I have a gain of 2.5 crore, I can only make an investment in 1 house and claim the exemption under section 54. But if I have a gain of 1.5 crore, I can make investment in 2 houses and claim exemption up to the capital gain. That means exemption under section 54 for house 1, exemption under section 54 for house 2. But both these houses have to be purchased within the timeline 1 year before, 2 years after, or 3 years after. Secondly, you can purchase one, construct one, that is okay. This 2-year option is once in a lifetime benefit, then you cannot claim it twice again in any of your coming time. Okay, so once in a lifetime only you can claim 2 houses ka benefit. But ma'am, don't we have to show the capital gain in the year of transfer and we have to file the return? But there is a time period involved which is later or before later than the date of filing of return. Then what we will do? Till the time you cannot make a decision on whether to purchase or whether to construct, for the purpose of filing of return and claiming the benefit, you can open a capital gain account, especially under the capital gain account scheme, and transfer your amount there and take the exemption benefit for the previous year. So suppose in previous year 1920, I sold a house. Okay. Now I sold the house on 2nd July 2019. Now roughly I have a time till July 2022 to file the return, but to make the investment, but the return has to be filed maximum by 31st July 2020, correct? Before filing the return, I have one option is to transfer the amount in my capital gain account scheme till the time I make a decision to purchase or construct the house. So that capital gain account scheme, the amount which is transferred has to be used within this time, and if not used, the amount which is transferred to capital gain account scheme would become the capital gain income of this year, that is 2022-23. But suppose I transferred into a capital gain account of 30 lakhs amount. Okay, before filing the return and I took the benefit, my capital gain was 40 lakhs, I took the benefit. And next 10 lakhs the capital gain aa gaya. 30 lakhs I transferred to my capital gain account scheme. Later, if you make an investment of 35 lakhs, cannot claim 5 lakhs more. No. Or later you make an investment of 25 lakhs till this date in a new house. The 5 lakhs which is remaining would again come as a capital gain income in 2022. Why? Because you have claimed the benefit and not offered this 40 lakhs, let's say 30 lakhs as the amount you did not offer, you claimed the benefit. Now in this 30 lakhs, it is compulsory to invest it by this date. If you invest more, then you are at loss, we cannot help. If you invest less, then you have to show the remaining amount as the gain in the year when the time period is over. Clear? And residential house into residential house is section 54. One section you understand clearly, the other sections are like actually a cakewalk. Is transfer of residential house a capital gain? Yes, very much. See, I told you personal movable assets are not capital gain, but personal immovable assets are definitely capital gain. Correct? So personal mobile phones ko I transfer. Personal cars transfer capital gain? No. Because these are personal movable effect and are not the exception of jewelry, archaeological collection, painting, drawing, sculptures, right? Or any other work of art. This is an interesting question. See, people will not do such things that you do not make a payment, that there is a time limit expiring, you took the benefit. You will not do such things, otherwise all the gains which you claimed in 1920 ka return as exempt. This amount which you claimed as exempt become capital gain, even if the circumstances are pretty genuine. I mean, any sale which is happening base year has to be taken as 2001. The question will not come for a sale which happened in 2018. A question for you will come for the sale which has happened in 2019-20. Okay. Could we extend the class by half an hour if that's fine? No, we will be extending the class by half an hour. Thank you so much. Section 54 talks about the residential house and then purchasing another residential house. For the house which is transferred, we get the exemption from the capital gain amount to the extent of the amount which has been invested in the new house or transferred in the capital gain account scheme before filing of return of income. But you have to remember that you have to use that amount within the time period specified, and don't act smart that after completion of 2 years you are purchasing a house from the capital gain account scheme. No, 2 years for purchase and 3 years for transfer. And not from the date you make the investment, but from the date of transfer. Not from the date when you transferred the amount into the capital gain account scheme. Wahan se you don't have to calculate 3 years. You have to calculate the 3 years period from the date of transfer. But this is only for individual HUF. Similar section is section 54B. Section 54 is the most important which will come for you. Section 54B happens, see, rural agricultural land is not an asset, but urban agricultural land is. If you have an urban agricultural land which you were using as an individual HUF for your agriculture purposes for 2 years period immediately before the transfer, and you sell that particular urban agricultural land, then any gain out of it can be exempt by making the investment in another agricultural land. Here the interesting thing is that the new agricultural land in which you are making the investment can be rural also and can be urban also. The condition is only that you have to invest in the agricultural land and not that it should be a rural or an urban agricultural land. Time period for making the investment is up till 2 years from the date of transfer. You have to make an investment in the agricultural land if you want to claim the deduction under section 54B. Here, again, if you want to take the benefit of section 54B, put the amount in the capital gain account scheme. Next is section 54D, where any assessee, it may be individual HUF, company, AOP, BOIs, who transfer land and building which were forming part of industrial undertaking. This comes very less, but who transfer land and building which were forming part of an industrial undertaking, and that industrial undertaking was for a minimum usage of 2 years, and then you make an investment in a fresh land and building. In a fresh land and building, you will get the exemption. That investment has to be done within 3 years from the date of transfer. Within 3 years from the date of transfer. But you have to remember this, that this is not a general case of transferring of land and building. This is a case of compulsory acquisition of land and building of the industrial undertaking. This is only for compulsory acquisition. That means if the land and building which was your part, the industrial undertaking is compulsory acquired, then only section 54D ka benefit can be claimed by investing in the new undertaking, Here, now 54EC talks about, this is very interesting and very simple. 54EC talks again is given to any assessee. Here only land and building or both are covered. That means assets transferred, the capital gain of land and building can be exempt. How it will be exempt? Transfer in new asset. What is the new asset? Here the new assets are bonds. Bonds of National Highway Authority, or Rural Electrification Corporation Limited ka bonds, RECL or NHAI bonds. Only these two bonds. Say Power Finance Corporation bonds are also listed and railway bonds are also listed. But these bonds may only you have to make the investment to claim the benefit of 54EC. But the lock-in period here is 5 years. That means you cannot sell these bonds for a period of 5 years. Here, what I told you, the exemption amount is either the amount which you invest in the asset or the capital gain, whichever is low. But here there is one more ceiling limit, that it cannot be more than 50 lakhs. That means even if the capital gain is of 100 lakhs or say 70 lakhs, I am talking about the capital gain. If the capital gain is of 70 lakhs and you make an investment of 60 lakhs in the bonds, maximum exemption allowed would be 50 lakhs. Maximum exemption allowed would be 50 lakhs, not more than that. By what time you have to make an investment? The investment has to be made within 6 months from the transfer. If it is not possible within 6 months, then you will not get the benefit. Ma'am, can we transfer it to the capital gain account scheme? No. For 54EC, there is no capital gain account scheme. You have to transfer it within 6 months from the date of, you have to invest within 6 months from the date of transfer. Ma'am, if the return filing date is happening before that, then you have to make the arrangements to make the transfer in that particular time. Redeemable, only the bonds which have a lock-in period of 5 years, you can make the investment, and only these two bonds, not any other bonds. These bonds which are there on your screen, maximum 50 lakhs amount. Otherwise, up tak we saw there is no maximum limit, but the limit here is the capital gain amount or the investment amount. See, all the exemptions in capital gain are allowed when you make the investment in the new asset. What you have to remember is, what is the asset which is sold? Basically, the capital gain of which asset against which I am claiming the exemption. What is the new asset? Then see which section ka benefit I can claim. Residential to residential, section 54. Land and building to bonds, section 54EC. 54B and D are not very for you. 54F again is very usage. Okay? But up till now, For all these three sections, you have to remember that the new asset in which you are making the investment, the new residential house or the new agricultural land or the new industrial land and building, you cannot sell that asset further for 3 years. For 3 years. You cannot sell that asset further for 3 years. That means the new asset co, there is a lock-in period for 3 years, and if you do so, the cost of acquisition of the new asset will be reduced by the capital gain exemption claimed. If you do so, the cost of acquisition of the new asset will be reduced by the exemption amount claimed. Okay, students, I'll take more time and see in the next 20 minutes maximum topic which we can cover. If we are not able to touch for income from other sources, I'll see what we can maximum do. Okay? I hope you people do not have any issue in relation to it. Next, 54EE is very similar to 54EC, but it will not come into a question because this is generally for startups. Totally similar, and you have to transfer within 6 months. But here the difference is, it can be a long-term capital gain from any asset. It can be a long-term capital gain from any asset, not just the land and building. Here also there is a 50 lakhs limit, but the lock-in period of those bonds or the units are 3 years. So just you can ignore section 54EE if any question does not appear in your module or in RTPs. Okay? Section 54F, very important and totally different type of exemption. The way of exemption is totally different. See, up till now, the exemption amount depended upon the capital gain or the investment amount. That is, you have to invest the whole capital gain to get the exemption. You have to invest the whole capital gain to get the exemption. But in section 54F, you have to invest the whole consideration to get the maximum exemption. Here you have to invest the whole consideration to get the maximum exemption. The exemption is not dependent upon the capital gain amount. The exemption is dependent upon the consideration amount, the net consideration amount. So here, this is only again available to individual HUF. You can transfer any long-term capital asset. You can transfer any long-term capital asset, but you have to invest in a residential house only. That means I can sell shares and invest in residential house and claim 54. I can sell gold and jewelry and make a investment in residential house and claim section 54F. Okay? But one condition you have to remember is that on the date when you are making the investment, in the new house, that is, on the date you are making the investment in the new house for the purpose of section 54F, you cannot have more than one house in hand. That means if I have no house, I can make an investment in new house and claim 54F. If I have one house, I can again make an investment in new house and claim section 54F. If I have two houses, I can make an investment in new house, but I will not get the benefit of section 54F. This is only for those people who have maximum up to one house on the date of transfer, who has maximum up to one house on the date of transfer and maximum up to one house ignoring the new house in that time period. The time period of, again, same, 1 year before, 2 years after or 3 years after. That means the new residential house can be purchased 1 year before, can be purchased 2 years after the date of transfer, or constructed within 3 years from the date of transfer. Again, I say, students, remember it is date of transfer, not the end of the financial year, not the date on which you transfer it to capital gain, not the date of filing of return. It is date of transfer. So remember, you cannot have more than one house for section 54F. There is no such condition in section 54, but there is this condition that you cannot have more than one house in the time period you make an investment in the new house. Now here, interestingly, the capital gain exemption calculated proportionately. The capital gain exemption is calculated proportionately. I told you up till these conditions, you have to invest the capital gain amount to get the maximum exemption benefit. Here you have to invest the consideration amount to get the maximum benefit. How will I get the exemption ka deduction? It would be exemption ka benefit, it would be proportionate. Suppose my net consideration is 35 lakhs. My capital gain is coming as 10 lakhs. For 54F, I made an investment in new house for 25 lakhs. Don't be happy up capital gain with 10 lakh minus 25 lakhs. You will not do that for section 54F. You will not do that for section 54F. Otherwise, for all those sections you did this, but you will not do the same for section 54F. For section 54F, the exemption would be calculated how? Capital gain into the cost of new asset upon my net consideration. Capital gain into the cost of new assets upon my net consideration. 7 lakh would be my exemption amount. So if I have invested full amount that is full 35 lakhs, that is full net consideration was invested, then you will see I would have got full amount as exemption, that is full capital gain as exemption. So I can say my capital gain would be exemption would be proportionated to the extent the investment in new house bears to the net consideration. Now what will happen if the date of filing of return is earlier than 6 months? Then you have to make arrangements to make the investment in that much time period in section 54E. Jyoti, if you do not make an investment, if you do not deposit the amount in the capital gain, then you will not get the benefit of exemption even if you had a full intent to purchase it. Income tax authority says that we need some proof that you have an interest to make an investment. Have an interest to make an investment. So that interest show it by keeping that amount aside, that you will not use that amount in any other thing. So keep that amount aside and put it in the capital gain account scheme. Here, now very important thing is the capital gain rates. Capital gain rates are taken in 3 sections: 112A, 11A, 112. First thing first, short-term capital gain are in general rule again I'm saying very general rule, short-term capital gain are taxed at slab rates. Long-term capital gain are taxed at special rate, which is 20%. Short-term capital gain slab rates, long-term capital gain 20%. Generally, what all are special rates in the income tax? What all are the special rates in the income tax? They are taxed at special rates. The income is taxed at the special rate, and generally you do not get deductions. The benefit of chapter 6A. You do not get the benefit of deductions of chapter 6A. So if suppose my total income is 20 lakhs, out of this 20 lakhs, 12 lakhs my long-term capital gain. So if on this 12 lakh, I will calculate tax at 20%, and on the remaining 8 lakhs, we calculated as per the slab rates. Okay, but if this 12 lakh is my short-term capital gain, so 20 lakhs pe pura you will calculate as per slab rates. Now 112A talks about long-term capital gain, very important, very important. Long-term capital gain on 3 types of assets: equity shares, pure-oriented mutual fund, and units of business trust. So 112A is a special rate which talks about taxability of long-term capital gain. Taxability of long-term capital gain on equity shares, equity-oriented mutual funds, and units of business trust, provided STT is paid on sale of and purchase of equity shares, STT is paid on the sale of equity-oriented mutual funds and units of business trust. So STT has to be paid. Then the rate of taxation be 10% if the capital gain is more than, if the long-term capital gain is more than 1 lakh. The long-term capital gain is more than 1 lakh. Then as per 112A, instead of 20% ka general rate, which is given in section 112, my 112A के हिसाब से my capital gain would be taxed at 10%. Capital gain would be taxed at 10%. And that too, the amount which exceeds, instead of if, that too, the amount which exceeds more than 1 lakh. That means, if as per 112A, that means if the long-term capital gain on sale of equity shares is 3 lakhs, I would be taxed at 2 lakh pay 10%, not 3 lakh pay 10%. So 1 lakh ka exemption benefit is given under 112A. Not 1 lakh pay 10% or 3 lakh pay 10%, it would be 2 lakhs pay 10%. 1 lakh ka it is a benefit. But again, in addition to lump sale bonds, no indexation. No indexation is allowed. No indexation is allowed. That means cost minus sale price minus cost सीधा करना है. No indexation, that is no benefit of second proviso would be allowed. So long-term capital gain on equity shares, equity-oriented mutual funds, units of business trust, STT should be paid on purchase and sale of shares and otherwise on sale. Tax rate would be 10% on LTCG more than 1 lakh. That is 1 lakh ka LTCG would be exempt. No indexation. Simple, you have to calculate. The question comes here as that what is the cost of acquisition? What is the cost of acquisition for such shares? Students, this concept was introduced by Budget 2018. So that's why here it is important to understand that you will take the cost as on 31st January 2018. Compare it. You have to take the cost grandfathered to 31st January 2018. Why? I will give a quick logic. Otherwise, please refer to a detailed class over it. People invest in equity markets with a long-term perspective. And earlier this gain was exempt. But the moment this gain become taxable so that it would not create an havoc and people do not feel cheated, they said that any gains which are up till 31st January 2018 would be exempt. So hence, the cost would be treated, would be the cost which is there on 31st January 2018. So your cost of acquisition, if I say, would be the cost for which you acquired it or the FMV on 31st January 2018 or the sale price, whichever is lower. Compare it with the cost of acquisition, whichever is higher would be your cost of acquisition. Ma'am, kya bola? So my cost of acquisition is 1,50,000. I purchased it in 2016. FMV is 2,50,000. 31st January 2018. And sale price ultimately is 3,40,000. In दोनों का lower, that is 250, and 250, 150 ka higher, that is 250, would be my final cost of acquisition to calculate the gain for section 112A. Would be my final cost of acquisition to calculate the gain for section 112A. So you have to compare higher of cost of acquisition and lower of FMV on 1st January 2018 along with sale price. उसमें से lower and compare with the cost of acquisition, whichever is higher would be your actual cost of acquisition for section 112A. Here, the reason logic is actually a thing to be discussed, but it has to be discussed in a detailed class, not in a revision class. Just in case if you feel that still there is something which you did not understand, you can give it. We again have a class tomorrow and we can take up the doubts. But I'll request you to join it sharp by 7 so that initial 5-7 minutes when we can take all the doubts. Next is 11A. 11A ka capital gain is short-term capital gain on the same assets which we discussed in 112A. That is equity-oriented mutual fund, equity shares, and your units of business trust, all listed on a recognized stock exchange, and STT on the sale. STT paid on the sale. Have to check STT should be paid on the sale amount so that it is assured that it is sold through a recognized stock exchange. Isme you have to remember that it is taxable at a special rate of 15%. Taxable at a special rate of 15%. Clear? But simple such is 3 types of rate you have to remember. Short-term capital gain in general, lab rates, 1/1, and long-term capital gain in general, 20% with indexation. Equity shares, units of equity mutual funds, and your units of business trust. Long-term capital gain, 10% without indexation, exempt up to 1 lakh. Short-term capital gain, 15% of the same things. But STT should be paid on the sale, and here STT should be paid on sale and purchase for shares and on sale for others. Clear? But yes, there are 2 exceptions to this also, which you can just remember that at an option of the assessee, this is not very important at your part, I'll again say, but again, it's my duty to tell, at an option of the assessee, at the option of the assessee, the listed securities other than units, can be taxed at 10% without indexation or 20% with indexation. Can be taxed at 10% without indexation or 20% with indexation, whichever is beneficial. Whichever is beneficial to the assessee, but you can ignore it. One very important thing which can come as question, last topic for the day before you all feel exhausted, is unexhausted basic exemption limit. Students, these are special rates, but these 3 sections, that is long-term capital gain on shares, equity-oriented mutual fund and units of business trust, short-term capital gain on the same, and long-term capital gain on other assets. If you have any unexhausted basic exemption limit, that can be set off and then the net can be taxed at a special rate. Meaning thereby, suppose my other income, I'll give quick example, my other income is just 1 lakh. Basic exemption limit is 2,50,000, so 1,50,000 is unexhausted. And my long-term capital gain at 20% is 3,50,000. Abhi tak you understood, ma'am, 3,50,000 pe 20% I have to apply the rate. Right? No. First 3 lakh, or I should not write 3,50,000, I should write 540. Unexhausted basic exemption limit is 1,50,000. This total exemption limit is 2,50,000. I have other income of 1 lakh. Is pe tax nahi lagega, 540 pe 20%. No. If you have an unexhausted basic exemption limit, set it off with the special rate of 112 and then offer the remaining income at 20%. That means 1,50,000 ko I will exhaust from my long-term capital gain. So 540 minus 150. 390 pay, I will calculate 20%. So this is a benefit given to assessees that if you have unexhausted basic exemption limit, can use it first with the capital gain and then offer the tax on the capital gain. Student, STT ka condition is STT should be paid, but the units which are located in the international financial service centers, they are exempt from applying STT. That means they cannot take the benefit of these 2 sections. They can. Yes, even if for the units which are located in IFSC, if no STT is paid, still they can claim the benefit of these 2 sections. Fair, Mansha? Okay, Himanshu says, ma'am, answer kaise dena hai? Suppose question comes for capital gain. Compute capital gain. Your answer sheet should only show the computation of capital gain as per section 48, which we call net consideration, transfer expenses, acquisition cost of improvement, and exemption amount. All other things will form part of your working note. Then why are you taking cost of acquisition and this amount? Why indexation calculation will go in notes. Indexation of cost of improvement will go in notes. Calculation of exemption will go in notes if it as per section 54F. Your main body of the answer should only have the computation. All other things will go in working. All other things will go in working notes along with reason. I'm sections कैसे याद करें? I think इतनी देर से I've been saying section 45 charging, section 48 computing section, exemption sections anyhow you have to remember. Exemption sections anyhow you have to remember. Okay, students, with this we covered up capital gain. I'm glad at least capital gain is covered in full. Income from other sources, I'll take a discussion for the faculties and see how we can compensate in the tomorrow's class. Okay? So, with this we cover up our whole understanding on capital gain. We'll not wrap it quickly till the time you people do not come up with the questions. 3 minutes for your question time and then we'll wrap it up. Okay, Nitya, in this 390 is a 112, which is flat 20%. If 390 would have been for 112A, then 390 में से फिर 1 lakh I would have reduced and then 10% I would have calculated. Very good. Same way, Himanshu, total income का भी question, computation part should be the main body, all other things in working notes. First refer to modules, then refer to your RTPs for the current year. Then you can refer to the previous year exams or RTP, but then be very much sure that your concepts are clear because the tax rate changed for capital gain, the CII has changed. Okay? You can refer it for the question understanding, but make sure that you have someone else to match your answers with. Okay? And please, you can drop up your feedback, anything which should be focused on, which should be taken up. Please drop your feedback soon and please make sure that you close capital gain in all aspects before you start up the class tomorrow. These are revision sections. Revision classes means that you have understanding of the basic things and revision is just for to make a quick enhancement of those knowledges. Okay? And in the time we meet again, keep yourself safe, healthy, stay home. That's the only thing you can do. And just focus. Don't let panic take space in the mind. Okay? So just focus. Everything will turn for the better. So with this, we end up the class. I hope your questions have been taken. And please go through the chapter. Anything which is left can be definitely covered up. Don't worry. Great. We take up a call. Thank you. Equity oriented mutual fund, Madhav, yes, 112 is applicable. Manshu, don't worry. More you practice, the more you will. Okay, with this, we'll end up the class. You guys, thank you. So we are done.